Hey everyone. Lately, the news media has focused on the idea that commercial real estate will be the other shoe to drop for the banking sector. That commercial real estate loan defaults will cause small and mid-sized banks to fail. This has been perpetuated by mainstream media, citing reports from a variety of sources that are either patently wrong or misrepresent the underlying data. A lot of the headlines have been provocative, alarming, and in many cases, wrong. I have to note, this video will be longer than normal because there's a lot to unpack here. I hope you do find extra value in it though. One headline I read said small banks hold nearly 70% of commercial real estate loans. Another read, why small banks and commercial real estate could be on the brink of a doom loop. As these articles and news reports, each one more dire than the last, have come pouring in, I keep thinking to myself, that makes no sense. How could small banks hold nearly 70% of all commercial real estate debt? How could commercial real estate be part of a doom loop? So we started drilling it. And let me start with this. The statement, small banks hold nearly 70% of commercial real estate loans, is false. We tracked down the original story, the one that set off the media echo chamber, and what they did was add up the commercial real estate debt held by domestic banks smaller than the 25th largest bank, then showed it as a percentage of the total. The original version of the story indicated that small and regional banks have 67.2% of the commercial real estate debt held by all U.S. banks. There are 4,746 U.S. banks. So if I told you the top 25 banks in the U.S. hold 32.8% of the debt and the other 4,721 banks hold the other 67% of the debt, it wouldn't be alarming, would it? So the headlines are wrong. Small banks don't hold nearly 70% of all commercial real estate debt. They hold 67% of the commercial real estate debt held by domestic banks. And banks, all banks, including local, regional, national, and international banks combined, only hold about 40 to 50% of the total commercial real estate debt. The rest of the loans were issued by U.S. government agencies, commercial mortgage-backed securities, insurance companies, and private investors. As for the small bank share of the total, according to MSCI, between 2015 and 2019, small and regional banks did 17% of total commercial real estate loans on average. They did 20% of the loans in 2021 and 27% in 2022. So small and regional banks probably hold around 20% of the total commercial real estate debt, not 70%. Then there's the other part of the story, that commercial real estate loans will default en masse and drive banks under. Yes, some commercial real estate borrowers will likely get into trouble, but the vast majority won't. Key factors determining distress include when the loans were written, when they mature, and how much equity the investors have in the property. There are a range of estimates on how much commercial real estate debt will mature in 2023. No one has the real number. They're all estimates, and they all use different methodologies. According to MSCI, approximately $400 billion of commercial real estate debt will come due in 2023. About $140 billion will be from banks, and the regional/local bank share is approximately $50 billion. TREP estimates $448 billion of commercial real estate debt will mature in 2023, of which $270 billion is with banks. Now, going back to that 67.2% share of the bank debt that's held by the smaller banks, we'll use that, and we get a rough estimate of about $180 billion of commercial real estate debt sitting with banks that are outside the top 25 largest. The Mortgage Bankers Association estimates there's $728 billion of commercial real estate debt that will mature in 2023, of which about $397 billion is held by banks. Using that same 67.2% as a basis for estimating, banks outside the top 25 have about $265 billion maturing according to the Mortgage Bankers Association and our calculations. These are just estimates. Consider this. Combined, the banks outside the top 25 have a combined commercial real estate loan portfolio of about $1.9 trillion. Depending on whose estimate you use, that means between 2.6% and 14% of these banks' total commercial real estate debt will come due this year. And the vast majority of the maturing loans coming due will not be in distress. There are two reasons for that. First, commercial real estate underwriting has generally been pretty conservative. The average loan to value has been in the 65% range. So generally speaking, a $10 million property would only have about $6.5 million of debt on it. The investor would put up the other $3.5 million. That means, again, I'm generalizing, borrowers would probably only default on the property if its value fell by 35% or more. Most properties don't face that kind of problem. That's partially tied to a second consideration. The debt coming due today was probably put in place about 5 years ago. Some investors use 3-year debt, some use 5, some use 7, others use 10, but 5-year debt is pretty common, so I'm going to use that for illustration. On average, commercial real estate revenues have gone up by 25.7% over the last 5 years. That factors in rent growth and the change in occupancy. The numbers vary considerably from property type to property type, with office being the weakest at just under 2.1% growth. So most properties are probably worth more today than when the loans were originated. But one property type does have more risk than the others. That's office. Because of changing behavior, more people working from home, office performance does face more risk. Depending on how you estimate it, somewhere between 19% and 25% of the debt maturing in 2023 will be office properties, and that's where most of the default risk lies. However, that probably won't be enough to cause bank failures unless a bank has really concentrated risk in office loans. Given all the resources the Federal Reserve and the FDIC have made available to support banks, I doubt this maturing commercial real estate debt will be a major problem. That said, one other commercial real estate default risk is out there. Loans with adjustable rate mortgages where the investor didn't get a rate cap. Roughly 55 to 60% of the loans written in the last few years have been adjustable rate mortgages. With rates having risen so much in the last year, these will likely face some distress vulnerability, especially properties acquired or refinanced using variable rate financing between the second half of 2020 through the first half of 2022, when cap rates were particularly low and underwriting was particularly aggressive. Basically, the risk here is that rising interest rates will push these properties into negative cash flow and the investors will not have enough reserves to cover the shortfall. I haven't been able to pinpoint how much of the local and regional bank lending falls in that category, so that segment will be a bit of a wild card this year. But I also have to point out that there is a lot of private rescue capital waiting for these deals, so even if they're upside down, the bank default risk is still limited. So in wrap up, I want to reiterate that the media tends to sensationalize information, especially negative information, so take it with a grain of salt. Could commercial real estate disrupt the banking system? Maybe. Will it? I have to say that's not likely. I encourage investors not to get bogged down in the big scary headlines churned out by the media. Instead, I recommend you keep your eyes on the horizon.